Hello, this is the itemized deductions video training. It's a pretty long one, so buckle up and come along for the ride. As usual, refer to your Pub 4012 and Pub 4491. They're very useful for you. So for deductions, you can claim the larger of the standard deduction or the itemized deduction. And as you're probably aware, the new tax law pretty much doubled the standard deductions, although it did decrease the personal exemptions. So this chart shows what the standard deductions are now, plus the additions of one or more of the taxpayers is over 65 or blind. They would get that additional amount for each. Now, if you do enter itemized deductions and they're not as much as the standard deduction, then the taxpayer will automatically select the better option. So again, if the taxpayer files married filing separately and the spouse itemizes deductions, then both spouses have to itemize. Or if they choose not to, they get no standard deduction. And if the taxpayer files with a standard deduction and then later the other spouse itemizes, then our taxpayer must amend the return. So for people filing separately, before you discuss deductions with them, you need to find out if they know what the other spouse is doing. So in the intake and interview sheet, you will see if they've checked any items that can be itemized. But please do not enter any itemized deductions into TaxSlayer until you have entered all of the other items, all the income, any of the other items, and then determine, do they still have any taxable income after taking the standard deduction? If they have no more taxable income, then you don't need to do itemized deductions and save yourself and the taxpayer a lot of time. If they do have taxable income after the standard deduction, then you have the dialogue about could their itemized deductions possibly get to the standard deduction amount or more. If either of you are not sure, then it makes sense to start entering the itemized deductions. So in order to do this in TaxSlayer in the federal section, go to deductions and then click on itemized deductions, and there you'll see a list of the categories. The basic main categories that we would see: medical, dental expenses, the taxes like income and property, mortgage interests, maybe points, gifts to charity, and some other items. Now, there are some scope limitations for us, and we can't do some of the things you see on the screen here. The one that might impact us the most would be non-cash donations over $5,000. The others we rarely see. Now, medical expenses, the first category. There's a lot of items. There's a very good list in the Pub 4012 Tab F, which has been taken from the IRS Pub 17. Use that as a guideline. This page here lists some of the things that can be deducted. Now, not all medical expenses qualify. The table B at the bottom, or the table on that sheet I recommended, shows some of these things. Diet food, surgery, funeral expenses. Insulin can be deducted. Some over-the-counter drugs, if they're prescribed, can be deducted. Medical expenses, like all of the things you deduct, they have to be paid during the tax year. Can't have been reimbursed by any medical insurance, including HSAs. Have to be for the taxpayer, spouse, or dependents. Now, there's special rules if you don't have a dependent because of the gross income test or somebody else claimed them, but you paid the medical expenses, you might be able to deduct those. Medical mileage is 18 cents per mile. So if the taxpayer used their car to go to doctor's office, hospital, urgent care clinic, pick up prescriptions, those can be deducted. For 2018, taxpayers can deduct medical expenses over 7.5% of their adjusted gross income. And then next year it's going to go up to 10%. So let's do a little quiz for you. Prescription sunglasses, can you deduct that? Yes, because it's prescription. Contact lenses? Yes. How about whitening of your teeth by the dentist? No, that's cosmetic. How about a gym membership fee if the doctor suggested you exercise a little bit more? No. How about cleaning by your dentist? Yes. Okay, this is a screenshot of what the TaxSlayer input screen looks like for medical expenses. You would enter here any medical and dental insurance that's supplemental or not social or not Medicare. If you've already entered the Social Security, Medicare premiums, those will be automatically pulled. So these would be things like supplemental insurance, a Plan D for prescriptions, or if they're not on Medicare yet. And then there's boxes here. You can see how TaxSlayer likes to have you divide up the medical expenses. Okay, let's move on to taxes that have been paid. The basic rule, again, is it must be imposed on the taxpayer. They can't deduct taxes they paid for somebody else. Again, you have to pay it in the current year. New in the tax law this year is this is limited to $10,000. The combination of state and local taxes, real estate taxes, personal property taxes, it's now limited to $10,000 a year. So this is the TaxSlayer screen for taxes paid. And you can see that there's state and local income tax, only things that have been paid that are not from W-2s, 1099s, estimates. Anything you've already entered elsewhere, don't enter here. If you're using the general sales tax instead of income tax, you'd click on the Edit Sales Tax Worksheet. We'll talk about that in a minute. Estimated taxes. Here is real estate taxes that you will enter right there. We don't do personal property taxes in Pennsylvania on cars. At the bottom, this applies if you're going to use the general sales tax deduction. And we'll go over whether or not you'd have to enter anything here. Okay, so for state and local taxes, you can deduct either income taxes paid or the sales tax. So some of our taxpayers still work, and in that case, usually the state and local taxes that have been withheld will exceed the sales tax, but you don't always know that. Or general sales taxes. Now, after you've entered all of the income in TaxSlayer, the sales tax deduction is figured on not just the taxable income, but any non-taxable income. TaxSlayer will automatically add back any tax-exempt interest or any non-taxable portions of pensions, annuities, Social Security. There are other items that you haven't entered into TaxSlayer that if the taxpayer has them, you need to enter into that last box on that page that we just looked at previously. So go to your Pub 4012, page D1 at the bottom. There's examples of income that's not taxable. For example, things like insurance proceeds, inheritances, and other things. You would have to enter that in order to get the taxpayer the highest sales tax deduction. Also, you would enter if they've bought a car, motorcycle, boat, airplane, if they have made capital improvements to their homes and they paid the sales tax, those things can be added as a separate line item in addition to the general sales tax. So the sales tax deduction sheet in Tax Slayer looks like this. You'll enter the zip code that they live in, number of days they lived there, and then you'll enter our 6% general sales tax. Down here is where you would enter any taxes paid on a car, boat, etc. On to property taxes. So real estate taxes, they're usually reported by the mortgage company on the Form 1098. It can be on a lot, parcel. Taxes, if they are related to things like benefit to the property, services like trash or sewer, homeowners association, can't be foreign taxes, has to be U.S. Those cannot be deducted. We don't see this in Pennsylvania, but personal property taxes could be deducted. And other taxes, foreign income taxes paid, normally our taxpayers will claim the credit. So you can't deduct things like obviously your federal income tax. If you're working, the taxes you pay for Social Security, Medicare, unemployment tax, gift taxes, the per capita taxes that you pay for the privilege of living in your township. Again, foreign, you can't deduct those. Let's move on to home mortgage interest. Normally, we'll see this on a Form 1098 given by the lender. The Tax Slayer screen, you'll have to put in the name of the lender and the interest amount. That screen also has a box for points that you can deduct. If they are points, there's a worksheet in Pub 17, Chapter 23. You could follow that to see whether or not all the points could be deducted in the year of the loan or if they could be amortized over the life of the loan. The interest has to be on what's called acquisition debt. It has to be on your main home or your second home. The mortgage would have been to buy or build or improve the home. And it has to be secured by the property. In other words, you can't mortgage your main home and buy a vacation home. And the debt on your home can't exceed its fair market value, can't be underwater. We rarely will see this, but there are upper limits on the loan amounts. If you had the loan before December 15th of last year, your loan can be up to $750,000. If the loan was after December 15, it can be up to $1 million. We rarely see taxpayers with this high a loan. Home equity debt. Up until this year, all home equity interest could be deductible, but the new tax law limits home equity interest deductions to only if you use to buy, build, or improve the home. You can't have used it to pay off, loans or other things like that. Also, we can no longer deduct mortgage insurance. A little bit on reverse mortgages, just for your information. There's really no interest paid or deductible until the mortgage is settled, then interest is paid. Again, the reverse mortgage proceeds would have to be used to buy, build, or improve the home. If it's used for something else, pay off car loans, credit cards, whatever, you can't deduct the interest. Now, you can't deduct as interest things like personal interest, interest on car loans, or credit cards, service charges, annual fees, loan fees, any fines or penalties. Okay, let's move on to gifts for charity. So charities have to be qualified. The IRS has definitions and rules, and they actually have a list. If we're not sure, you can go online and check it. Again, we rarely see any limitations, but there are limitations. You can't give away a lot of money if it starts to get as a higher percentage of your adjusted gross income. And again, we rarely see these limitations, but they do exist. For the taxpayer's information, gifts to charity require documentation in case they're audited. If it's less than $250 to any charity, they can rely on, their records, a canceled check, credit card, bank statement, something from the charity. If the gift to the charity is more than $75, the charity has to say if any goods or services were provided. For example, did they get a hat with a logo on it? What's the value of that? It has to be deducted from the donation value. If the contribution's more than $250, a charity has to give them a written acknowledgement. And again, state the value of goods or services. And remind the taxpayers that they're responsible for the documentation. We don't need to see any proof. We just rely on them. Again, we're doing their tax return for them. We rarely see these, but if you have a foreign exchange student, you can deduct for that. If you also have a foster child, you can deduct anything you haven't been reimbursed for. So you can also deduct non-cash items, clothing, household items, etc. Again, the fair market value, normally it's what you give to Goodwill or Salvation Army, their value has to be good used condition or better, according to the IRS. We can't do the tax return if they want to deduct capital or business property. Boats, vehicles, or planes, unless it's less than $500, then we can do it. Now, you can also deduct volunteer expenses as long as your charity doesn't reimburse you. 14 cents a mile if you are a volunteer, tolls and parking, and any out-of-pocket expenses that aren't reimbursed for you. Now, again, if any items more than $250, the charity has to give you written acknowledgement, and the taxpayer is responsible for the records of non-cash contributions. We can do non-cash contributions up to $5,000, but if it's more than $500 total, they have to complete Form 8283. There's a separate entry into TaxSlayer for that. Taxpayer has to provide the information. There's a lot of detail. For example, you have to enter the description of the property. How much did it cost when it was acquired? The date it was acquired, or various. How you acquired it? The fair market value at the when you acquired it. I'm sorry, the fair market value when you donate it. How did you determine the fair market value? What's the name and the address of the organization you donated it to and the date it was donated? So for non-cash contributions more than 500, you have to have all that information. You can't deduct contributions to some organizations. They aren't on the list. Businesses, chambers of commerce, civic leagues, social clubs, homeowners associations, communists, that's still left over from an ancient tax law. Lottery tickets, raffle, bingo. Now, you can deduct gambling losses. We'll talk about that a little bit later. Tuition, the value of your time, the value of your blood, you can't deduct that. Contributions you make to an individual, anything that benefits you. And theoretically, you can't deduct cash donations unless you have a receipt for it, because you couldn't prove it. So in TaxSlayer, for cash contributions, you'll get a screen like this. Now you can enter individual charities, but most of the time we would group all the cash contributions together, click the override button, and then you just enter one total. There's also a screen for non-cash contributions. You would enter charitable miles. Non-cash, if it's less than 500, you would enter it there. There's a separate screen, as I said, for non-cash if it's over 5,000 or over 500 in total. Miscellaneous deductions. There's some changes in the tax law. What used to be subject to the 2% of adjusted gross income threshold has been eliminated. No more unreimbursed employee expenses, tax prep fees, investment fees, safe deposit boxes. Those have gone away. Other items not subject to the 2%. Sometimes we'll see gambling. So if somebody has gambling winnings, they can deduct the costs or losses up to the extent of the winnings. We rarely see any of the other items here on this worksheet. They're in your Pub 4012. So when you're doing a quality review of itemized deductions, make sure you have a dialogue with the taxpayer to ensure they're all considered. If they deducted last year, you might look at their Schedule A. Review the documents. Has everything been entered into TaxSlayer properly? The preparer can summarize with the taxpayer, explain why itemizing does or doesn't help. If their standard deduction is higher than these itemized amounts, it doesn't pay. Thresholds, if necessary. Remind them of the need to keep the records and receipts. So you made it this far. Phew, that was a long one. If you have any questions or comments, you can direct them here.